Hello, everybody. My name is Daniel Young, and I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market investment strategy using closed-end funds. To get the normal disclaimers out of the way before I jump into things, this is an unedited video, so who knows what you'll hear in the background as I film these in my house. Uh, I I will be honest that I am tired today. It's been a lazy day at the house, which has been good. But at the same time, if I uh, stutter more or lose my train of thought more, that's probably why. I am not a financial advisor. I am a strategist and a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So please continue to help me hack YouTube in the sense of, I mean, yes, I want my channel to grow, but the bigger thing is helping more people learn that there's a better way to invest than the traditional stock advice. The 4% rule doesn't work. The 60/40 stocks to bonds portfolio method is dead. Tracking indices and money market account is good to see. There we go. Money market accounts are good as like savings accounts, but it's not great long-term money savings. I mean, if you're getting 4% in a money market and you can get, which I'll get into, 10% plus, uh, that's quite a difference. So help me help more people learn that there's a better way to invest. Closed-end funds give us so many more advantages than traditional single stock investments. And the odds of keeping your principal intact and living off dividends are so much higher when you don't have to worry about selling your principal, right? You're either keeping your principal, ideally growing your principal, and then funding your life or funding retirement with 8% plus dividends, but it's really like 10% plus dividends. So if you had far less than the market recommended average of portfolio value, if you had far under what the current recommended minimum is to retire, and the current recommended minimum is over 1 million. If you had a if you had a I'll do the math on screen, or maybe you don't see my screen, but I'll pull up the calculator. If you had a $300,000 portfolio and it had a 10% rate, right, or a 10% yield, you'd be making 30,000 a year or $2,500 a month. Maybe that's enough to fund your retirement. Maybe that's enough to supplement your retirement, right? If you had a $500,000 portfolio and a 10% annual yield, you're making 50 grand a year, and now you're making 4,100 a month. And if you do that through a money market account or a cash brokerage account or an IRA account, all of that's going to be taxable income. If you really hack the system, really push past the traditional advice and go your own way and do it through a Roth investment, then so long as you jump through the hoops, all of that money is tax free. So if you're willing to take on your retirement and become a self investor or a self directed investor, there's so much more possibility and potential out there for you than following the traditional brokerage advice. And I will repeat what Robert Kiyosaki says. Most brokers, most investment brokers leave you broker than they are. And that's been our experience. And I'm kind of wondering if it's your experience too. So if you're up to the challenge, and it is a challenge, if you're up to the challenge, take on the responsibility of your retirement and your lifestyle and do the work yourself. And if that seems beyond you, it's not. But if you still think it's beyond you, then yeah, watch my videos and learn. And hopefully you'll see that it's not beyond you. You're quite capable. But if you still think it's beyond you, then find a brokerage service that will help you and where you have a lot of input on what they do because it's your money. I mean, at the end of the day, If you're trusting somebody to invest it for you, like a fiduciary, it's your money. They're honor bound and ethically bound to help you and do what's best for you, but it's your money. So you should invest it how best you see fit because it is your money. Now, I don't want to invest your money for you. That was never my goal. That's not my purpose. Right? My purpose is twofold. One, to tell you what I'm doing and why, because it's insanely important for me to be able to verbally justify what we're doing. Because if I can rationalize it in my head, that's one thing. But for me to verbally say it out loud and have it make sense, that's something completely other. But then two, it's to help more people realize that there is a better way to invest than all of the traditional mumbo jumbo and, quite honestly, all the traditional shit that you find out on the mainstream. All those teleprompter jockeys either A, know what they're saying and misleading, and B, they have no idea what they're doing and they're just reading a teleprompter. Take it upon yourself and do your own investing. It'd be the best thing. From my stance, it's the best thing you've ever done as an investor because now you get to control the helm of where your money goes. And if you make a mistake, nobody's perfect, right? Don't purposefully sink your ship. Don't put my ongoing stance on diversification is diversification for the sake of diversification is foolish. That being said, don't put everything into one basket, right? You can diversify so much that it very much is like what Bilbo Baggins said. I feel like butter scraped over way too much bread, right? The the bread toast is great, but buttered toast is better. But if you have too much bread and not enough butter, then it's not as tasty as it could be, right? But that being said, if you put everything into one basket and the basket breaks, now you have nothing. So you've got to find a comfort level for you on diversification and define it for yourself and then stay within those confines. On my angle of things, the best thing I ever did was be challenged. I realized that our structure was not going to bring about the end we wanted. And I took on a huge challenge. And that fits my needs. I love data. I love intel. I like reading articles. I like teaching people. So this is a great method and means for me, right? But on your end of things, you have to play to your strengths. And even if your strengths aren't data and reading articles and figuring stuff out and looking at things from a macro perspective, like giant market, and from a micro perspective, like of your own market, you have to find people that are good at those things. Because if you want the ability to control your money, then you have to be pretty darn close to the spear or pretty darn close to the tip of the spear and knowing where your money goes. You can't just be at the back end of things, throwing the spear, hoping it gets there. You've got to be at the forefront, knowing exactly where it's going and why. And if you're trusting somebody else to throw the spear for you, maybe their aim, maybe their strategy, maybe their methods, maybe their spear is just not as good as yours. So the best advice I can give you is to continue learning and take on the challenge yourself. And if it's too much for you, if it really is, then find somebody you trust who will do a much better job than who you currently have. And if you sincerely trust your current broker, kudos, because you found a unicorn or you found the needle in the haystack. But on my end of things, I love doing my own thing. I really do. It's been amazing. Not I mean it's not all it's not all giggles and grins by any means. But it's challenging and I love the challenge. So where do we stand for the week? Um, I've got notes, not quite like the normal notes. I mean, I've got notes, but it's not the complete strategy review. It's not the complete system review. I will own up that I was right about the market fluctuations regarding Iran from last week, but it was very short-lived. Once the ceasefire was announced and both Iran and Israel's leadership was rebuked and put in place by an irate Daddy Trump, the market responded. And then also spurring the market higher or further was the president's and the vice president's public spanking of Jay Powell for sitting on interest rates again. Uh, Powell actually, there were two people on the board that were like, yeah, maybe we'll have cuts in July. And Powell was like, nope, not going to happen. We'll see. What a schmuck. Uh, so you have Powell sitting on interest rates. You have the Trump and Vance SCOTUS wins, and then more announcements of companies investing into the U.S. Plus, you have to factor in the end of the week's announcement that China and India have trade updates in relation to the U.S., and we're set for that economy train to just keep chugging along. And we all want a strong economy, but that's going to make our picks a lot harder because when everything costs more, it makes it a little bit harder to choose. And in times like these, when the market sentiment just screams and pushes into greed and extreme greed, you have to either choose to invest, sit back and wait, hoping for a pullout. Uh, you have to target you have to target unloved sectors. There we go. Or mix and match as needed, meaning play it on, not so much play it on a whim, but at the same time, not be afraid to change your strategy by season to buy season or buy time to buy time. And for us, we could wait, but we could be waiting a while. Because if you look at current market momentum, I'm sure there's bound to be a scare tactic or a fear factor or a dip at some point, but nobody knows when that's going to be. And even if it is, honestly, after a significant dip, like we saw with Tariff Liberation Day, after a significant dip, data shows that for the next year, basically, you can buy almost anything and see a profit, which just seems like crazy data to me. Because I think the discount, the price point, and the dividend, all of that still matter, right? It's not just randomly picking stocks and bonds and everything else. So instead of facing it willy nilly like everything's going to win, we still have to be hyper selective of what we're doing and why. And that tech boom isn't going to go away anytime soon. I also think the market's going to continue to expand and lift. And if Powell surrenders to the data because, that is his fucking job to respond to the data, the Fed has got to the point where it likes to craft their own narrative. Whether you agree with the Federal Reserve or not. Okay. And I'm on the end of not. But whether we agree with it or not, the Federal Reserve is supposed to view the data and respond based on the data, meaning inflation's low, respond. If inflation is low, rates should be low. If inflation is high, rates should be high. So with inflation going down, and it's been going down, Powell is sitting on high rates. That doesn't make any sense because the Fed's job is to both control inflation and control the rates based on inflation, which just sounds like job security to me. But Powell has not been, and it's the board of people, but it really is Powell. He's not been adjusting rates based on inflation, right? So he should surrender to the data. There should be a rate cut in July because there should have been a rate cut 4 to 5 months ago. But if he surrenders to the data and rates drop, then the economy and the market break open. And we're nearly there as it stands. I mean, mortgage rates are down. Mortgage rates are down. It doesn't seem like they're down a lot. They're down almost 0.25%, but it's still a drop. And it's dropping not because of Powell's steady rates. It's dropping because inflation's going down. bond prices are on the rise and the market itself is climbing. And the more positive commentary we get about the US market, meaning the US economy overall, like the CBO, the Congressional Budget Office, estimating this big, beautiful bill will cut into the deficit and only encourage. So it'll cut into the deficit and cut into spending, and that only encourages more market favorability. Now, I don't trust the House or the Senate. And I say that as a whole. And we can get into politics, and it's not my goal to get into politics. With President Trump's and Vice President Vance's recent track record, the last 5 months, they've done a lot for America. I think they have the political clout to say this is what we want to do and put together a giant bill. Me personally, I've said it before, I don't like a giant bill. There's too much in it and too much that can get lost. But politics is all about compromise. So if this is the best way to package it all together, I understand. I trust President Trump. I trust Vice President Vance. I do not trust Congress to sneak other shit in the bill that we don't need. And that's kind of where I am. So there's a lot of good in there. There's also a lot of not so good stuff in there. And I'm curious how much not so good stuff is going to get left in there. So last week we were debating specific funds based on mixed market sentiment, meaning covered calls look great because you could play that better than average hope that stocks would rise, meaning we're kind of neutral to better than average on the overall outlook. Covered calls make sense. But now with the market climbing higher and almost everybody projecting the market to go higher, covered calls don't look so good just based on the strategy of it, unless you already own that. And if you're still lost on covered calls, I think I say this later, but if you're still lost on covered calls, pick your favorite search engine, and or me, I like Grok. But type in there something simple, something like explain covered calls to me for the stock market in extremely simple terms, and it'll break it all down for you. But I've done that twice now. I don't want to do it again in this video because it'll just lengthen out the video. So if I'm investing now, if we're investing now, and we are, we will prioritize the long-term strategy, which would be to use the current market to our advantage. The goal is to fund our lifestyle and retire on dividends or supplement a retirement on dividends, right? We want to protect and grow our principal, knowing that it's going to fluctuate up and down while our funds pay us the majority of that overall growth in dividends, meaning flat line. Let me go back to my video view. If you flat line the market, right, you know it's going to do this. Everybody hopes it does this, but the reality is it does this a lot. So as it does this, we want to get paid dividends. Now we want the principal to grow, but we also want consistent dividends. We want growing dividends, right? So to make sure all of that happens, we must demand a discount and scoop deals where possible. Why pay overboard when you don't need to? So here's what we're currently targeting and why. And the why is a huge factor because lots of people, even the one group that I pay for, tell you what to buy, but very few don't always tell you why you should buy it. And the why is important. I mean, just like your personal why is important, which is a different conversation. I mean, if you want to know what that is, I'll put it on a comment. Just let me know. But the why of stocks is important. Without the reason to buy, what's the point of buying? Like, you should buy this. Perfect. Why? I'm not going to tell you. That doesn't really help me. There's no way to justify the expense other than that guy said I should do it. That's not really great support for you. So here's what I see from my 30,000 point view, or is what I've been saying. Here's what I see in the tea leaves. You could argue for almost anything. but I'm not targeting everything. I see a bull market on the horizon. And that means bonds and their proxies are prime contenders. When short term rates fall, bond prices will rise higher than they've already risen. And hopefully, on that end of things, we'll see some type of special dividend from some favored funds at the end of the year. Stocks, there's if you look at the stock market, it's not the stocks and bonds and mutual funds and money market, right? It's stocks. Everything is a stock, or you're buying a stock or a share in something, right? So, in the general sense of things, stocks are just shares of a company, and they can relate to any type of investment in the market. On my end of things, I tend to refer to stocks, yes, as shares, I get that, but I tend to refer to them as single investment opportunities, meaning single investment companies. So if I look at the difference between stocks, which I don't, between stocks and bonds, right? Both are still stocks, but I'm just saying individual. So like Amazon, Meta, Alphabet, Nvidia, ASML, IBM, pick your bond company. So stocks, which would be in a neutral to hopeful mindset, covered calls would be great. But on the precipice of a bull market, which is more of a it's more of an extreme greed or a differing strategies market, because if the market goes full bull, like bull in a China shop bull, or being chased down the street bull, everything will push into extreme greed, and you'll have the option of sitting, right? As people push and push money into the market, they're going to jack the prices. They're going to buy available shares and the prices will go up. We want that. So you're going to have the option to sit on that and just watch the price go up, or you can have the option to find an unloved sector and buy something really cheap, right? But when it comes to covered calls, it's not really the best place to be unless you're already there, because you're investing on hopeful sentiment, not bull sentiment. Covered calls sell on risk from both the buyers and the sellers end of things, right? And a known cost of higher prices is disadvantageous to both parties. So, like I said, if you're still lost on covered calls, go search it with AI, which kind of gets into all the kind of gets into the AI tech boom, right? But go search it on AI and see what you can learn. And that gets into if outright tech was overpriced last week, it is sailing right now. Last week, Microsoft was the largest company. This week, Nvidia is the largest company. They're going to keep trading back and forth on our juggernauts between Nvidia, Microsoft, Apple, and who knows, maybe somebody else will join the pitch. Right? Single company tech investments are expensive and they really don't pay you a dividend. Right? But we get better deals and access in the closed-end fund corner of the market space, in the market space. So that's really good for us. Okay. Many are pushing stocks, meaning individual companies, but almost no one is explaining why. So I'll share what I've read and I'll also give you my takeaways. So what I've read, it's a there is a prevailing fear that the worth of the US dollar will decrease because of our expanding national debt. And this comes from the one group I pay for, my most trusted market analysis group, who knows that current inflation numbers have dropped. And the CBO's report that the new big beautiful bill will lower spending by again that coincidentally reused number of $2 trillion. And we know that there are no coincidences. When we see that number pop up so often, something's got to be tied to it. Okay, so if inflation is going down, why are there still fears of devaluation? Because that's really what inflation is. Inflation means your currency is devalued. It takes more of it to buy something. All right, so the US has to pay back its debt somehow. And with Jay Powell leveraging short term rates and not letting Scott Bessent refinance that $9 trillion on the Treasury end of things, which is even something President Trump has hinted at recently. He's in his recent truth of Jay Powell and his testimony before Congress. He said Jay Powell is costing the United States billions because of not allowing us to refinance at a lower rate, right? And we've got debts to pay. And since the US dollar is still a global reserve currency, and since the Federal Reserve has a printing press, the common thought against most market analysts is that they'll simply print more to pay it off. And that makes sense. I mean, I don't like it, but it makes sense because it's government and the Federal Reserve loves their own power. Just think of that for a power trip. No, I'm not going to lower rates. Figure it out on your own. But at the same time, they'll gladly print money and just pay off a debt and essentially blame somebody else for it. Now, more paper money, the more paper money that gets printed devalues the rest already in existence. And inflation happens, but the rate doesn't decrease or the rate doesn't increase, however you want to say it. So if all of that happened, right, you got to pay off the debt, the government just prints more money, poof, here's your money. That should impact the overall inflation rate, but it doesn't. More money float, which I think is shady as all get out. That is shady as fuck. Right. So more money floating around means more investments into the stock market. And that's what most everybody thinks. But the fact remains that all of these analysts, even the ones I like, just cannot wrap their heads around the external revenue service idea. And it's more than an idea. It is now a created government department. So the External Revenue Service would take tariff money and pay down the debt and offset that bloated US budget. And it would do so outside of Congress's control of the money. And I think that's key because if Congress got the money, they would spend it on shit. And you and I both know this. If you give Congress money, they automatically view it as their money and not our money. And they spend it on a lot of other crazy shit. Just listen to all the stuff that Doge has found. That's what our money was going to, not the United States, to all this other shit. Right? And that's Congress. Now, maybe it's not Congress as a whole, but I'm definitely lumping in Congress as a whole because everybody else who knew it was happening and didn't say a fucking word about it still let it happen. So if the money goes around Congress into the ERS and Congress doesn't touch the money, I think we're much more likely to actually pay off the debt. Right. And if all of that happens, and it is a big if because it hasn't been done, but if that does indeed happen, then it's a completely different ball game. And you factor in the ongoing idea, and it is an idea, and it's being talked about being lumped into that one big beautiful bill. Factor in the ongoing idea that there's so much extra tariff money that everyone making less than a certain threshold, it's been 150, 160, and $200,000, will not pay taxes. And if that happens, it is a brand new day for Americans. And it will impact lots of different people. But if you look at the working professional level of employment, and if I skip your profession, I apologize. It's not my intent. But you look at firefighters, police officers, and teachers, right? As a working professional teacher, my annual taxes of married filing jointly fall right in that category, fall right in that range. That would impact me and pretty much everybody else in my district. Okay, that's huge. Huge. If that happens, it is a new day for America and a new day for Americans, which also means it will be a new day for the stock market. So as for the argument for a weakening dollar, it doesn't make sense to me. And it's certainly not enough on its own to convince me to target anything outside the bond and bond proxy world. That said, there are a few points that would make me consider non-bond investments. I mean, it's still a bond and bond proxy environment. But Brett Owens put it this way, and I'll share the screen because that's only fair. I don't like reading stuff. I don't mind reading through my notes and adding in all the details. I don't. I like to share schematics with you. So let's see. Let me share my screen. And on your end of things, move that out of the way. Here. No, I can't really get rid of the bar on my end. So if it's on your end, pause the video and read. And then once you get down to the bottom, now you can finish. Oh, maybe that's a better view. So I'm not going to read the whole thing to you. There's currently about $7 trillion housed in money market accounts across the United States, which how they formulate this data, I have no idea. Because, I mean, you'd have to be willing to share uh, I don't know, general account data with somebody else. That just seems like an invasion of privacy. But maybe they're doing it as money market account data based on overall firm worth. I don't know. I don't know how that works. All right. So based on the image, all those investors who have money stacked in a money market account, which all my general savings at Fidelity is in a money market account because that's better than the uh, say Fidelity is like, hey, we can house your savings in a money market account, or you can work with a partner bank and get less interest rate. And it's like, well, heck, I'll just keep it in the money market account. Is it really easy to take money out of? Oh yeah, super easy, which is true because that's what happens every time I buy stocks. Right. So I can get 4% from Fidelity, or I can get, I think, less than 2% from a partnership bank. So it's in a money market account. So I get that end of things. But all those investors fear the massive US debt, which I agree. It's grossly mismanaged. Congress has completely fucked us over. Right. I get that. President Trump actually has a solution to pay it off, which none of those people can fathom because it's always somebody else's problem to fix. It's never their fault. It was always a Congress before them. But nonetheless, the herd fears the debt. And Wall Street as a whole, including all these analyst firms, cannot wrap their heads around an ERS. It's so far out there that it practically does not exist for them, which is true because I have not read a single investment article featuring the ERS system. So while we know it exists, we must pretend that it doesn't for now. So these investors are hoarding money because they fear the debt. And they can't see the US printing their way through payments or the US paying off the debt. And add in that their go to media source is hyping that fear, we have an opportunity at hand. So, do you remember what happens when the herd gets fearful? The market dips. But would this is rhetorical and also my musing. Do you really think we would see a dip in the market after a rate cut? I don't. I think it would be odd indeed to see a dip, right? My mind, it's like the Fed cuts rates and the market takes off. So my guess is that if there's any dip from the herd pulling money out, it's masked by the upward trends that would follow the rate cut. And I honestly don't know if it would be marked as a dip because they're really just it's a money market account. Invest like it's a market account, so you're pulling money from one account and shifting it to another. So if you're shifting money around, it's not necessarily pulling money out of the market and hoarding it. It's just shifting it from one investment to another. But when rates fall, those money market rates will fall too. of which I'm well aware. I don't know how that would impact my money market account interest rate, but I also know the money market interest rate for a savings account, like for an emergency fund, are still better than what a bank can pay. Okay, but I'm not hoarding money in there for my retirement. I'm hoarding it in there for emergencies. Slightly different, well, very different strategy for a very different end goal. So when rates fall, the money market rates will fall too. And that will cause the herd to look for an alternative source of income. And it should send them into the funds that produce consistent dividends with low stress. And the best corner of the market for low stress and high dividends is closed-end funds. And the best corner of that market space is bonds, municipal bonds, and bond proxies, which is where we're already invested. And even of those three, municipal bonds they are boring. They are boring as all get out, but they do just keep chugging along. They have super low default rates, they pay high monthly dividends, and they pay a tax equivalent dividend. All of that sounds really great to us, but it's also fairly common. But for a herd investor coming from a 4% money market account, that's my rate, right? A municipal bond paying a tax equivalent yield close to 10% is a godsend. Do you kind of catch my drift? Like, do you catch where I'm looking? Does it make sense? And if not, tag me in the comments. So would I target something else? Like, it's still very much a bond proxy market, but would I target other parts of the market? I would target outright tech, Meta, Amazon, Apple, Microsoft, Nvidia, right? And companies that would heavily benefit from tech because we're still at the forefront of the current tech boom. We want companies making tech used by everybody, and we also want everybody who needs all the tech. Now we're profiting from both ends of the spectrum. So I would target real estate. There's an adage in real estate. When we bought our first investment property, we were told it's a high rate market, and it was. It still is. If you can make money now, you can rake in a low rate market, which is true. If you look at your mortgage at whatever it is now, like the current national average is 6.8. If you look at your mortgage on a 6.8 rate and compare it to a 4.8 rate, doesn't seem like there's that much difference, but there's a very big difference. And on the investment side of things, it widens your gap of profit, right? But now apply that in mass. A real estate company or real estate investment trust doesn't just have one property or one type of property. They have thousands. Lower rates and more square footage available means more profits. And on rates, most people associate lower rates with a troubled job market, but that's not always the case. I mean, in this instance, inflation is low because the government department chairs are not spending as much money, and the Federal Reserve isn't printing money outside of resolving debt issues. That you have the job market humming along, and GDP is now projected to reach at least 5%. That's a huge win for President Trump's economy. So why are CLO prices dipping or collateralized loan obligation prices dipping? It's of the 5 or so CLO funds I track, they're all relatively down. And I honestly don't know. There was a huge scare last week, but even that, there was a huge CLO scare last week that I read about, but still didn't really like. I understood the fear regarding the quick sell off, but I also didn't make sense to me. Um, so I honestly don't know the current dip in CLOs, but I do know that when they do dip into discount territory, they're worth the consideration. So the one CLO fund, the one outright CLO fund we have, maybe 3 4 weeks ago, I did a video about a new CLO fund on the market, and then I looked at current bond companies we own, and quite a few of them are invested or investing in CLOs as well. But the one fund, OXLC, that specifically targetedly invests in CLOs rarely dips into discount territory like it has been. Therefore, it's on my options list or my funds to consider list. All right, so that leaves us with bonds, which would be bond proxies like real estate, municipal bonds, utilities, energy transfer. You could link CLOs to bonds or just leave them separate, but either way, CLOs, and then companies that would profit from outright tech or secondary technological advances, which would be all of them. And honestly, what funds tech, what funds microchips is oil. But oil current from our end of things of where we're targeting oil and the companies we're targeting with oil, uh, of what we currently have, none of those funds are on discount or meet the metric on discount. They're all uh, doing what we want them to be doing. They're lifting in value and closing the discount. Although I might present you with an option. So let's get into this. Enough of my talking, or at least enough of my strategizing and backstory. Let's look at the actual data. Uh, I will share my screen and you will notice I have a lot more tabs open than normal. So this is not the entire closed-end fund master, but I went through the closed-end fund master and updated, well, everything with a target. Yeah. So from one asterisk up, 60 funds. Um, it's not the full system update that I'll do next month. That takes a considerable amount of time. But everything color coded got an update between uh, current cost and current net asset value. So of the options, uh, one asterisk we track, two would be a dollar cost average based on what we already own, and three is based on either, well, it's based uh, on a buy alert. It means the existing discount is double the historical or greater than double the historical and higher than the 5-year discount, unless it's a new fund or a newer fund, and unless it's an exception, which there's three exceptions to the rule, um, of which only one I think actually makes this list now. I want to say PDO is a possibility. Get lost, and then DNP is the other. Currently, only ADX exists in discount territory, or in outright discount territory, put it that way. But now let's take a brief look at that. It'll be easier to find for sure. Let's see, DNP. Yeah, we want the discount to be at or below the 52-week average. So at 8%, that would be above 5%. And then PDO, pretty sure it's PDO. Yes. At 3%, fine. We'll add PDO to the list. Well, we will and we won't. PDO is the option there. Um, oh, fine. We'll add it to the list. I'll clear it out later. So to get these in order, we rank by discount, we scale by target, I had made the list, but that's okay because we'll just paste over. And now we start the thin out. So everything on the list is there by discount, except for those three funds that are dollar cost average moves based on what we already own. And we're targeting pretty much everything to a degree. Uh, on my end of things, if I'm adding a bond company, it's got to be better than what I currently own. And PDO is great because it has a PIMCO brand, but it's not necessarily better than what I already own. So on my end of things, it will not make the list. But actually, let's further divide the list. I'll go through my normal metrics. That'll make things easier. So everything's justifiably here by discount. All right, yeah, that's a good breakdown of what we're targeting. I want to target monthlies unless there's a good reason for keeping it. And I'm going to keep one on the list and we'll see what happens. Although I haven't dug into it, but if you're interested in, and I've seen several recommend this fund, it's just, it doesn't fit on the monthly scale of things. And of all the funds I have at the top, it's not an option for me to review. Watching somebody who's new in my street. Um, and it's close to 9%. So if you're looking for a real estate fund, maybe that would be an option for you. But well, I don't like doing crazy investigations on videos, or at least unnecessarily long investigations on videos. So it's not going to make the list. ADX will stay for reasons that I'll get to. So we go by yield. We want 9% or above, unless there's a good reason for keeping it. So these don't make the list. These three do, because although they don't have the right dividend outright, when you look at the tax equivalent yield, they do. We're looking at Calamos will stay on the list for now, and BXG, we already own it. That'll stay for now. ERH will not make the list. It's a utility fund. Uh, yes, it's not going to stay based on dividend. Yes, it's currently in discount. Me, I have a history with Allspring, having invested into one of their funds previously. I'm not a huge fan of Allspring, and at the same time, this company's dividend jumps. I don't want inconsistent dividends. CHW will stay for reasons I'll get to. ETV will. Realty is a relatively new fund, and I get that it's considerably higher than JRS, but it pays monthly, and it's real estate, but not real estate how it's traditionally thought of. So, if you're looking at real estate funds, look at JRS, look at Realty, look at HFRO, which is just above this. Um, HFRO still has the biggest discount, uh, but it's slowly closing. Price is slowly going up. I still think the fears are overblown. Um, it'll stay on the list for now. ETB CIF is a bond company. So yes, it meets the metric, but of the pendulum between however you want to arc your pendulum on the lower company, not lower company, smaller company size end of things, you have CIF. On the polar opposite end is FCO. And I think FCO is still better structured for this current economy. I bought CIF on the roller coaster, meaning it did this, and we bought it low, looking back at past history, going, hey, at some point when rates actually do get cut, they'll swing high. And we are still kind of in this range, waiting for it to jump up. And if it'll jump up, great. We're going to sell it, take the profit, invest it somewhere else. But and I get the market is a roller coaster. I get it comes in waves. I get it's cyclical, all that stuff. but I found that I dislike the roller coaster, um, or the outright uh, bumping, bouncing pattern of things. Um, it's not my style. Meggie is Maggie's a great idea when it's near or it's better than the 1 year discount. And you could argue that it's close to the 1 year discount. It's less than 2%, but it's also higher than it's been. Um, I mean, it's a bond proxy. It's worth keeping on the list for now. FCO, bond company, that'll stay. PDO is not better than what we currently have. Maybe it is for you, but not for us. Uh, let's see. That's if I'm looking at, yep, there it is. So if I'm looking at OXLC, and I am, Eagle Point's a great CLO company. They invest in other stuff besides CLOs. Earn is a new company, and their company missives said they were a company specifically investing in CLOs. But when I pull up their current Morningstar data, which maybe it's not current, but when I pull up their current Morningstar data, they're invested in more things than CLOs. And we already own companies that are invested in a higher rate of securitized debt than Earn is. So I get that they pay a great yield, and I get that they're brand new. I mean, the CEF investors are hesitant for new stuff, and I see myself as less hesitant than the next person, but the data doesn't match in the sense of if we own five different bond companies, and I forget the number, but if we own five different bond companies and they all invest in CLOs amidst corporate this and like if they're all structured out to derivatives and government bonds and corporate bonds and CLOs, and I'm picking up Earn thinking that it's primarily invested in CLOs and it's not, then adding it to my portfolio that's already mixed in all those other spreads doesn't really add anything to my portfolio. It's simply adding another company that specializes or might be specialized in CLOs on top of what I'm already invested in. But from my standpoint, that is diversification for diversification's sake, and it spreads my money too thin. I want targeted investment. So if I want a company that specializes in CLOs. I think EIC does, but I'm already invested into CLOs through other bond companies, as well as this one group who specializes in CLOs. Plus, you're asking me to pay more than double of what I can get per share on this. So I'm just going to stick with what I currently have. River, which might be a great fund, but it doesn't add anything for me. It's not different than what we currently have. If you ever find a mistake on my videos, then by all means point them out. But I'll tell you that there is a difference between end of day closing price and what CEF Connect had as their end of day closing price for these funds. End of day closing price on Webull for FCO was 724, and CEF Connect had it as 711. So it could be closing price and then Webull factored in all of the after hours trading, or I'll find out if there's a different part to it on Monday. Um, so not necessarily in price, but if you see mistakes in my videos, point them out. All right, River doesn't really add to anything. Saba nope, Saba keeps. Pimco, same thing. Doesn't really add to anything. So that leaves us with this, but it's not going to be the final list because I have all these tabs at the top. And I have all these tabs for a reason. So I've talked about sets of funds before. So if I look at the Calamos funds, and then if I look at the Eaton Vance funds, we look at Calamos and where they're invested. right? This is CHW. This is CGO. They're very similarly invested. If I check out their price history, which is easier to find on CF Connect than Morningstar, but I look at their overall price history, it's very similar. And it's honestly, it's not the straight roller coaster, but it's very bouncy. See, we have these, it's like a basketball bouncing, and sometimes the gaps are wider, but this bouncy roller coaster style system that maybe it's based on rates, you know, or maybe not, but same thing, very bouncy pattern. On my end of things, I don't like the bounces. Now, I get the market will go up and down. I do. And I get, and I'll show you in a minute, that not, I mean, no company has the straight, perfect line going up, right? But I want companies that, for the most part, have stellar track record, unless the new stuff, right? If it's new, you're taking a bigger gamble because it doesn't have the track record. But we want companies that do this as opposed to this. And Calamos, uh, what I like about Morningstar, go up to the top, you can read overall strategy if it'll pop up and show again, right? So they're not doing covered calls or anything. They're looking at general growth, different like convertibles, things that can switch between stocks and bonds, preferred shares, and they're looking for growth, but they're not trying to pad their dividend or upscale their dividend with covered calls. But if we look at it from a strategy perspective, I don't like the ups and downs of things. I don't like the roller coaster. CIF, not CEF. I will pull up CIF. CIF has a very similar pattern in the sense that it bounces, right? And we saw this opportunity and we're like, hey, it bounces. At some point, it's going to hit $3 again because that's its history of bounces. And we've been stuck down here. And you can say it's rates, and maybe it is. But at the same time, waiting for the bounce to happen is not fun. Now, because of that, Calamos doesn't, it's been on my target list a while, but it's become less appealing. So then we look at the Eaton Vance, and there's another one. So there's ETB, ETV. I think there's an ETW that we've been tracking for a while. Their portfolios, they're still well laid out. It's still tech, it's still outright tech and secondary tech, however you want to explain it, right? It's still tech companies and then companies that will profit by tech. Now, are they weighted beyond what I would be comfortable? Like normally, I'd like 3% or less, maybe 2% or less. That right. But at the same time, these companies are targeting tech because the tech boom has just happened. So I completely get it. So if there's and this applies for every fund currently, you know, even the Calamos ones, they're targeting specific tech investments. It's like tracking an index. If there's another dip in the market, all of those things will go down, like everything else will, and then all of those things will climb back up. So if you're overweighted in tech and the tech market dips, you can expect your overall value to plummet, and you buy the dip, right? And you wait for it to come back up. Now, on the Eaton side of things, very similar track records for both companies, very similar. And it's a better bounce pattern than Calamos, but it's still very choppy, right? If we look back to where they started, and maybe there's more company history before 1995, maybe. I know for sure ADX goes back a long time. right? But of since 2010, it's been pretty consistent across the board and still bouncy. And they sell, they pad their dividend with selling calls. NBXG does the same thing, but we're already invested in the NBXG. And yes, from market launch, yeah, the world was shut down. This was post COVID, right? You have that bottoming with rates, and then you have the slow climb up. And I will admit it's bouncy, but it's a more definitive line up. There we go. Than these. We can rate it by 5 years because that's the same track record of NBXG. You have NBXG, right, for 4 years. From 22 on, it's pretty much a straight line up. From 22 on, it's kind of bouncy, like really bouncy. So they're appealing in the sense of how they support their dividend, but they're unappealing just based on the bounciness of their track record. So, and I get it, like they're tech focused, they're tech heavy with primary and secondary development. And like I get it, but if I'm trying to optimize and really target both where I think where I think the value is and the long-term strategy of things, I've got to be hyper choosy of things right now. That leaves me with two companies. And I get there's a third thing here, which I'll get to. But that leaves me with a company we already own in BXG, which is tech heavy, right? It's not, they don't have Apple or Tesla in the top 25, which is interesting. But besides that, I mean, if I pulled back the other funds, the Eaton Vance pair was like 160 different investment companies. If I pulled up the Calamos things, you're looking at like 600 different companies. That's and without, I mean, without getting into everything they're invested in, when I look at these companies, which both currently are marked with less than 100 investments, you have companies that are specifically targeting the tech sector and things that will profit by tech versus companies targeting everything. That resonates with me because that's it's diversification for diversification's sake from a portfolio in a can. And you have these two, which are still portfolio in a cans. Newberger less because it's extremely targeted investment across 5 sectors. And then you have Adams, which is a portfolio in a can. I mean, a little here, a little there, more in different places. But it's also U.S. dominant. Newberger is similar. It's still U.S. heavy, but it's not all into U.S. But between the two, and we look at track record, I mean, NBXG you already saw. We look at Adams, you have this up and down pattern, I admit, but you also have this rise right here. We can look in the last 5 years that it is up and down, I will admit, but it's still up. So the question becomes on my end, can I move past a quarterly payer? And the truth is, I don't know. $21 is beyond my general comfort level. I like 15 and under. I mean, it's marked for 16 and over as being just out of contention. 15 is really my limit. I don't really invest in things higher than that. I've done it and I've been burned a lot. So 21 definitely exceeds my comfort level. it would be a challenge for me to invest. But I also know the track record and I can scale it. I like that they've normalized dividends. And I don't know if they'll keep the year-end dividend almost like a special dividend. And I think that would be pretty cool. But I would prefer a monthly payer. That said, they have a phenomenal track record and they pay a nice dividend. And it's a solid blue chip investment. And between ADXG, or sorry, between ADX and MDXG, I think they both cover us well on the technology, like on the outright tech end of things, between, gosh, even Berkshire. So I don't know if I would be able to buy a quarterly pair because I like monthly, but it's a hard pass. I mean, it really is. You can argue that it's not close to 10%, 2.7 away. You can argue that. But of reasons that would convince me to get into tech, not just the hope of a rate cut or the assurance of a coming rate cut at some point in time. We are at the forefront of the tech boom. And I don't know when rate cuts will happen, but whenever they do, the entire market will respond positively. But even it's that it's not a coin flip. A coin flip does not give you two choices; it gives you three because there's that rare occasion it lands on end. The overall market sentiment is not if rates get cut as opposed to when. But even if rates never got cut, ADX will make a profit. They'll just make more of a profit if rates get cut. So of covering the technological end of things, of covering the stock end of things, I want to invest into I want to invest into companies that are very targeted in how they approach the market. So having a smaller portfolio, a dedicated investment strategy, a track record of things, I like that. And that might just convince me to pick up ADX this next round. We'll see. There's at least one sleep between now and the time I buy stocks or I buy our next round of things. Now, what else would be in the mix on that? These three for sure. Municipal bonds, I think, are a great ongoing, like the current culture of the market, the current environment of the market is still bond proxy based. I think it's a great play whether rates get cut in July or later. And I think the herd will search for additional income options if money market rates go down. We've talked about these at length. HFRO is real estate. I think it's a great play. Um, on my end of things, we're invested at 1,000 shares, and I could sounds duplicitous or like almost like I don't believe in myself if I say this, but you cannot always buy everything. I mean, it's got the biggest dividend. It has the biggest discount. It has a decent dividend because the price has fallen. I don't believe the light at the end of the tunnel is a freight train. I still think it's open space. More square footage online and better rate environment would be amazing for them, amazing for everybody. But if we're going to buy ADX, I can't buy the other stuff, and that's kind of the diversification for diversification's sake mantra, right? We're already invested into MBXG. You buy a lot more of that without picking ADX, and that's kind of the way I have to play in my mind. But if I'm going to do that and invest more in stocks, not so much I'm going to invest a ton of money into stocks. It's just I'm going to invest in stocks instead of just bonds and bond proxies. Then I can't buy everything. HCO, this one, I'm not happy with it. I think they diversified the company for diversification's sake. It used to be very targeted. I loved it. And then they opened it up into more things, and not a fan of it. The company's done well. The price has gone up. I'm happy with that. The dividend's great. I just don't know if I'm going to keep it or sell it, to be honest. Uh, Maggie might be a great pickup at its current discount, but if I'm buying ADX, I'm also or NBXG for that matter, I'm taking money away from what I could put somewhere else. So we're going to pause on that one for this month as well, and that leaves me with this list. So we already own. Actually, I can do it different. So if this is our list, this is how I've been doing it for me. So if this is my list, so this is what I have to invest. This is what's left after these amounts have been taken out. This is what I've essentially what I've spent. Uh, so we currently own the most of BRW and FCO. I think we own 1,200 shares of each. So whenever I buy one, I like to buy the other, and I like to keep the amounts equal. These we have 800 shares a piece, I believe. Same thing. Whenever I buy one, I like to buy the others. I keep all the investments equal. But that's me. That's not really a strategy behind it. That's just me, and I like round numbers, and I like that they all have the same thing. Uh, OXLC we already own. I think we have 200 shares of that. Yes, this is our current portfolio. OXLC, we have 400 shares. We've bought 200 allotments at 408. It would be by far the lowest buy-in. We just stick with the 200 and make it match the others. It it gives you a it's easier to find the average, which I get it. The spreadsheet does it for me. Uh, The spreadsheet is set up to do it for me. At the same time, I can come back in and do the average with a basic calculator if I needed to. So that leaves these two. NBXG, I think we have 200. Yes. If we bought ADX, we would not have, right? So we pick up 200. There's not room to buy 100 set of ADX. So that would leave me with that. So yeah. So you're looking at essentially $15 a month, but at the same time, you're not going to get it till the end of 3 months, or in this case, 4 months, because of that off cycle. And that's kind of the thing. It like, and on my end of things, I can buy a company that's well positioned, well invested, has an amazing track record, is paying a consistent dividend, and is poised to grow. All things that are great for us, all things that are great for everybody. But it doesn't pay me monthly. And that's just when we started, I was all for monthly and quarterly, and I mean not semi-annual, not annual. That's too long to wait for a dividend. But I was okay with these off-cycle dividends or like an alternate pattern, category two, meaning it pays in the second month of the quarter. When we started, it would have been fine. But since I got into targeting monthly dividends, it's really hard to consider a quarterly payer or like an alternate quarterly payer. and you're asking me to consider it at a price point higher than what I'm comfortable with doing. So I can argue for me buying this company. I can also argue against me buying this company. But of in that counter argument of the other options listed for tech investments right now or blue chip investments right now, I can't think of a counter for ADX. And that might be the point that sells me. At one point, there's a fund with the ticker USA. It pays quarterly, but based on it's an automatic, it's a dividend reinvestment program. It's an automatic drip, meaning they pay you the dividend, take it back, and reinvest it into the fund. So you never really see a cash dividend for it. ASG is their sister company. They're set up well too, but they have a drip set up too. I like cash dividends. I like to be able to invest the dividends where I want them invested, not necessarily where their company wants them invested. So it's really hard. I have a hard time finding a challenge or a challenging company to put against this one that meets or well that exceeds the data that I've already given you. So it sounds probably crazier to you that I'm thinking of not doing it, but it goes back to it's not a monthly payer in that price point. So that's kind of what I've got to mull over, and I've got at least one sleep before I buy our next round of before I buy our next round of investments. So we'll see what happens, and whenever that happens, based on somebody else's request, I mean, I'll make another portfolio update video and why, and it will be shorter than this video. Um, but this is what I have for right now. So CLO, bond fund that's a share activist fund that invests in a lot of other stuff, FSCO, ADX, and what I forgot about ADX, the last tab. ADX is invested into tech, and it's all US based equity. They are invested into one other fund that is not considered a match on Morningstar to all those other funds. They are invested into another Adams fund. And it's which I think is it's the best thing I've seen all day. Second best thing I've seen all day. But they are listed as natural resources and not anything else. But these are all oil companies and energy transfer companies. So they're heavily invested into tech and all these companies that will profit by tech in the fund proper. And then they're also invested into oil and natural resources and energy transfer, natural gas. I think that is a huge addition to their investment structure, and I like it. So for now, this is my list for the week. Um, However you spin it, I think the market holds a lot of promise. I think there's a lot of potential in the existing market, whether Jay Powell does his job to cut rates or not. And if he cuts rates, and it'll be the Federal Reserve cuts rates, but let's be honest, if Jay Powell cuts rates, the market breaks open. So play it how you will. I mean, your money is your money. Your money is for sure your money. And we'll play it how we will. And if, we'll say when we update the portfolio, I'll let you know. So whatever you have for the week, I hope it goes well. It's July 4th week. It'll be a very big week, but locally, nationally, it'll be a very big week. So whatever you have, I hope it goes well. Whatever you're doing fireworks wise, have fun, stay safe, come back in one piece. If you like my content, then please, yes, consider subscribing to my channel. Help me hack YouTube and get the message out. So share the videos, comment on the videos, and then hit the like button. And that way more people get to see this information. So if you want to find me day to day, drop me a comment. And then otherwise, I really do. I hope you have a great week. I hope your celebratory plans go well. And whatever you have going on, I hope everything works out in your favor. So have a great week, everybody. Bye-bye.